Okay, we are back. In this segment, we are picking up where we left off in our strategy, trading, and development course. I'm joined by my colleague, Tom Snyder, CMT. Tom, thanks for being here.
Mike, my pleasure. How you doing?
Good, good, good. So in this segment, well, let's do a little recap. In the last segment, we talked about the strategy performance report. We were working with a built-in sample strategy that comes with NinjaTrader, which is a moving average cross strategy. But the next step, once you have a strategy, once you've looked at the performance, the next step in the evolution of that strategy is to try to refine the strategy using the process of automation. And that's what we're going to talk about today.
Right, exactly. I think, the progression we've had so far is a natural progression of how to improve ourselves as traders. And we've gotten to the point to me, which is really the meat or a lot of the work in backtesting, which is not, it's funny, it's not backtesting, but it's the optimization of backtesting. So maybe we can just get right into the chart and do a little bit of recap of the strategy we've been looking at.
Absolutely. And during this session, we'll talk a little bit about what optimization actually is, how to do it in the platform, what it can do for you and what it can't do for you, and some best practices, maybe some pitfalls to avoid. So take it away, Tom.
So what you're looking at here is a modified version of the sample strategy that you'll find in your NinjaTrader platform. If you have a chart up, you can right click and you'll notice you might be familiar with adding indicators. Well, right underneath there is something called strategies. Excuse me. And you get 4 sample strategies. I have not explored creating new ones yet. I know Mike's a little more prolific with that. But the second item is the moving average. MA stands for moving average crossover study. Now I've already added it and I've changed the defaults. Looking at 3 and 10 as the moving average periods rather than I think the 10 and 25 that are there. I've already added it. But one key thing here, Mike, and you really turned me on to this, is once it's added, you won't see anything on the chart until you hit this enabled button. So make sure that when you add a strategy, whether it's a sample or your own, you want to make sure it's enabled, and that kind of locks in all the parameters so that there's no mistaking what you see on the chart. Once you hit OK, you'll see what I see, which is not only the particulars of the study, the 3-period moving average and the 10-period, but also as if we had traded using those indicators to trade, where we would have gone long and would have gone short.
Yeah, there's a couple of things I just want to point out here. So think of a strategy as a way to test an idea historically. And then once you have that strategy refined the way that you want it, you can trade that strategy moving forward with strategy automation. That'll be the next topic in this series. But just to be clear, the red line that you see, the little redded dash line, that's the 3-bar moving average. And the blue line there is the 10. And when the red crosses above the blue, we go long on the next bar at market. And when it crosses below, we go short on the next bar at market. And the strategy reverses long and short. And we can look at the performance of that historically.
Right. And that's the great thing. If we go to our control panel up at the top, I have mine at the top. You can go to new and you can pass most of the items at the top. About 2/3 of the way down, you'll see strategy analyzer. And this is key to what we're going to talk about today.
So, in the chart by itself, you can do the back test, you can look at the performance report, but when you get to the point where you want to refine the strategy, and what we're talking about today is optimization, the strategy analyzer is the window and the tool for us that allows us to do that.
So when you first pull that up, it's not reflecting what's on your chart. We need to change some of these settings to reflect what we saw. So the first thing is I want to make sure I choose the right strategy. Here it's the sample moving average crossover. But remember we talked about changing the lengths of the moving average. So I'm going to change the fast length to 3. Fast always is the smaller number. Now we'll talk about that when we talk about optimization. But generally the fast moving average is a smaller period moving average, and the slow, it takes a little bit longer to calculate, is the bigger number here. Now, The other thing we want to look at is the type. By default, it pulls up a minute chart. We want a daily chart. That's what we're optimizing on. We're looking at results from a daily time period. I believe the rest of this we can leave untouched. This date range, though, we'll come back to that when we talk about optimization practices. So I'm going to hit run. Now we don't say, okay, we're actually running this because it's going to, well, the one thing I missed, we need to select an instrument. I skipped right over that. And I'm going to use the E-mini December, E-mini S&P December contract. And when I hit run, it takes those parameters, the 3-period moving average and the 10-period, and trades the next bar after it crosses either up or down, stop and reverse. And had we done that using those parameters, here are the results.
So here, we look at all trades, long trades, and short trades. So you can see how the long trades did by themselves, how the short trades did by themselves, and then what the cumulative performance is. And there's a number of key performance measures. And again, we talked about this in the last session, how to interpret this performance report. But I think a picture is always worth 1,000 words. If we click in the drop down in the upper left, we can look at an equity curve here on analysis. Yes. I think that's right. There you go. And so here we can see the profitability of the strategy over time. This is kind of what we want to see. We want to see it building profits over time. Certainly, there's going to be some drawdowns. This strategy is in its, it is in a very basic form where it's just reversing. We don't have any money management exits or any other filters. So we're just getting the raw performance of this particular idea. But with optimization, we can do some refinement and try to make this performance better.
The way I look at this is we're evaluating, are these good signals? We're not talking about, like Mike said, trading the strategy with all the risk management and all the profit targets, other ways to get out of the strategy. This is evaluating these 2 moving averages as signals. And the question that comes up when we see these results, let's go back to the summary, because the top line, I think, is one quick way to see if this is something I want to pursue. And it's, is this profitable? And right now it says all trades, if you take all the trades for the beginning of the year using these rules, we would be up 17,000 and some odd change. Now, of course, we're not trading this real time. This is all looking back at history. So things may be a little different. If we had actually traded it, there's slippage, etc. But what the question that comes up, Mike, to me is, can we do better, right? Are these, 3 and 10, those are somewhat arbitrary, right? We might have a good idea about the 3-period and the 10-period, but are there better for this market? And so the thought is,
and it's interesting, just real quick here. And when you say better, by the way, Tom doesn't just mean the top line, bottom line net profit number. He's talking about a combination of performance measures that reduce risk, possibly, that improve the percent profitability. So there's a number of performance factors that we're going to look at when we optimize. Yes, we want it to make more money if possible, but I'll tell you, I would take less profit if there was less risk, or it was more profitable more of the time. So there's a number of moving pieces here that we're going to look at.
right, everything should be should fit within your risk profile, of course, number one. What I can do with this analysis is I can rename this tab. Let's just rename this real quick. And I'm going to call this ES for the symbol. I'm going to call this 310 for the 2 moving averages, and we'll call this 2024 for the year. This is just kind of how I think of things in terms of optimization or backtesting. You need 3 things, right? You need a symbol, you need some set of parameters, and you need a date range. Now I simplified it to 2024 because it's the beginning of the year, but it helps me for future comparison. And what I can also do, I'm going to hit apply. And now we've changed that tab. The reason is because I want to compare. And so Mike and I were talking, well, maybe the 10-period moving average isn't what we need. Maybe it's a 20. So what I can do is I can duplicate this tab, and it says duplicating will force us to rerun, and that's fine. It doesn't cost us anything. It'll quickly run. And now I'm going to change that slow period moving average to a 20, and we'll rerun it. And I'm going to rename this just for clarity's sake, so I know what I'm looking at when I'm looking at tabs. I'm just going to change that 10 to a 20. It's purely a label. It doesn't change any of my results. It's just for me. But now I have another window, another summary result that I can compare. And right away, just from memory, I see that profitability, just one measure on all trades, went down by almost half. And I can confirm that by just flipping to the other tab. We were at 17,000 plus. Now we're at 9,200 plus. Profitability went down. And that might shape the way I look at this strategy and say, this isn't maybe the right way to do this. But there's
So
a better way to do it. Mike, you could probably explain.
so what I see here is that the first thing that jumps out is that we have less trades, right? We had 20 trades on the first one. We only have 8 trades here. So to compare apples to apples, I think a better performance measure might be the average trade, Tom, which is 1,160 here. What is it on the 310? So that's 886. So the average profit per trade actually went up on the 320. It's just that we have fewer trades. So this is a good example of why we do this kind of work, is because we want to compare different performance measures and try to get to a solution that is best, like Tom said, for our risk profile.
And you can look at these trades as we divide them into long trades and short trades, see what happens to those as well. And just remember, we've been in a bullish environment for almost 2 years. So I would focus more on the long trades than the short trades, but you can focus on those as well, see the changes. But this gets very tedious, Mike.
Correct. So there's a way to automate trying to find which parameters are best for our strategy. And that's just by changing the backtest type from backtest to optimization.
So what I'm going to do is I'm going to duplicate this tab again. And it pops over here. It says Analyzer. Over here in the top right, it says Backtest Type. We can go to Optimization. And this gives us some other things to think about. When we run this optimization, it's going to perform a heavier analysis. It's going to do many backtesting analyses at almost, consecutively really fast. So the question is, what do we change? And there are a couple things you can change when we talk about optimization. You can talk about uh, the settings of the studies, right? The moving average periods. That's the most obvious, I think, for me. But you can also test on different time frames. So we're testing on a daily. Maybe you want to test on a 4-hour chart or a 5-minute chart. You can test on a different date range. So we give that capability. Right now, we're testing on the same date range, but maybe I want to, and this is key to optimization, I think we'll talk about in a little bit, is you definitely want to test it over different time ranges to see if you get consistent results. We'll talk about that in a moment. And then you can also test over different symbols, but you have to be prepared. You probably will get different results, and it only really matters if you're testing or trading in those symbols that you run the test on. So I think to start, Mike, what we'll do is we'll think of a range. And we'll think of a range for the slow period moving average or the slow moving average, and a range for the fast moving average. So we were using 3 and 10. We tried 3 and 20. What do you think are acceptable ranges for that slow moving average, Mike?
So I think for the slow moving average, we can keep it at 10 and maybe move it out to 20. I think that's a good range.
Okay.
And we can, and again, now it's the increment, right? The increment is, do you look at 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, or do you set it to 2 and look at 10, 12, 14, 16, 18? So I think for this test, we should leave it at 1 so that we look at every possible solution. And
I
then
agree. I agree.
and then on the fast, we don't want the fast to overlap the slow. So in this case, I would go from 3, let's say, to 8 in increments of 1.
Now we're using very small ranges, and that's why I think it's good to use the increment of one. But if you decided to boil the ocean and you said, I want to use 2 to 200 for both parameters, then Mike, I think we would either do 2 or 5 or even 10 to see how we would have done, because odds are you probably won't trade something like a 47 versus a 169 moving average, right?
And by doing that, you can then zoom in on those parameters that most affect the performance and a smaller range that you can then kind of delve into.
Exactly. So very key to know that these three numbers, it's interesting. If you didn't know, why do I all of a sudden have three numbers separated by these semicolons? Well, it's the first two are the range, and the third, very key, is the increment that we look at. So everything else remains the same. We started with a daily chart from the beginning of the year to the current day, and all we need to do now, it's basically running every iteration of these increments for the fast and slow moving average. And
In this case, Tom, that'll be 66 unique tests. And what's amazing about this is that for each of those 66 tests, it's going to apply the data, it's going to apply the strategy rules, it's going to create a performance report, and then it's going to summarize it for us. The speed that it does this is just incredible.
one more thing, Mike, couple things you want to look at when we hit the optimize section. Keep the best number of results. So generally, if there are 66, I don't need to know all 66. I want to see the top 10 best results. But to your point, Mike, how do we measure best? Well, we have to tell the system what best
So
is.
I'm gonna challenge you on this because one of the things that I do when I'm kind of delving into these smaller optimization groups is that I do want to look at all of the tests because there's a robustness factor here. How many of those 66 tests were profitable? And so if only the top three out of 66 are profitable, that's not very robust. But if more of them are profitable, that could give me an indication that I don't have to be so exact in picking the right parameters. Almost any of those parameters might be good. So it's just a robustness test that I sometimes do. Again, maybe again on the larger kind of these initial optimizations, setting it to the top 10 or 20, I think is valid as well. But as I get deeper into the optimization, I want to see how many of those tests were profitable.
So let's do this. Let's keep all 66 because we can do that. The optimize on is, to your point, Mike, profit factor is probably the number one thing everybody looks at, but you do have other factors. You have a bunch of factors, right? And so we're not going to go through them all here, but you know that you can factor on, you can sort or optimize on that drawdown amount, that Sharp ratio, the profitability per trade, per long trade, per short trade, all those things you can select optimize on. We'll leave it at max profit factor and we'll just hit run. So it's going to give us a little different bit of a view. But how quick was that? 66 different iterations in about 2 seconds.
Pretty amazing.
So what it does right away is it gives us the results at the top sorted by the best result according to what we told it to optimize on. Here's the total net profit. And it tells us that, wow, okay, on the E-mini for the past year, 5 and 15 moving average periods, the 5 period crossing the 15 gave us the best results. And so, and it also tells us some of the other factors we might want to look at. So I can see right away, well, the total net profit was about 30,000. We did 38 on the profitable trades. We did 8,000 on the non-profitable trades, and our max drawdown was 5,300. So
If
we can make judgments around that.
Exactly. And again, the you'll notice that there's a highlight in that upper box there. That gray box is telling us that the performance report below is based on that parameter set. So
Correct.
the performance below now is showing that, and we can see all the different parameters there.
Right. We can go into depth into each result based on those parameters, on those moving average parameters.
The other thing is, Tom, I think we can scroll to the right in the upper, is that true? I don't see a scroll bar. If you click there, can you move to the right? I'm not sure.
Yeah, it doesn't give me much more than these 8 or 9 columns here for
And
the
that's why we
results.
have the performance below.
Exactly.
That makes perfect sense. So here, I mean, what's interesting about this is as you click down through that upper box, we can look at the short trades. And in that first one, the short trades are profitable. And if you just kind of click on the next one, the short trades are profitable. So again, at that point, they become unprofitable. Does that continue? Yeah. So one of the things, Tom, scroll down through that list in the top. There's 66 there. Just kind of show everybody that all 66 are there. And if you scroll all the way to there you go. See, there's the first one that's not profitable. So the majority of these are profitable. So that's a
Right.
good sign for robustness, which means that, remember, we have to pick a set of parameters to start trading moving forward. And if only a couple of these are profitable, it kind of limits what we're going to select. But in this case, 50, 55 of these are profitable. And as time goes on and markets change, we don't have to be so exact. Whatever we pick here probably has a good chance of being profitable trading forward.
And it also shows us that we don't have just a couple of these combinations that are profitable. And so they might have caught just a random winner, right? That others didn't. You kind of have all of these, a majority of these set of parameters to some degree profitable, right? And, the next step for me would be, okay, well, if just the indicators are profitable, what happens if I add risk management to it? What if I add different ways to put an absolute stop, a trailing stop, maybe a moving profit target that might supersede what we see in the indicators? You might see some improvement in your strategy.
You certainly you certainly would see improvement here. I mean, to your point earlier, here we're just kind of testing the entry. So I think we've proven that the moving average cross entry is pretty robust. Now, we can go back to that strategy, add some risk management. Maybe this is a trending strategy, maybe add a trailing stop, maybe add some filters for market bias and slowly, incrementally make this strategy better and better.
Exactly. Exactly. So once you've got, so you can rename this tab. I might rename this something like E-mini 2024 OPT. I don't really need to know what the range is if I'm happy with that. If I'm not happy, I might put in the range of, or maybe first iteration. I don't really need to do all the details, but if I'm happy with it, the reason why I might want to keep the year in there, and we'll hit apply, is because the next part of optimization is let's test the same optimization over a different time period. So what I can do is I can duplicate this into a new tab. It'll rerun. That's fine. I'm not really worried about the rerunning. It shouldn't change too much. And so over here, we see the date ranges. And you could there are different ways to optimize on the date ranges. You might take 1-year slices, right? You might take 5-year slices. You might look at different regimes, what's happening with interest rates, what's happening with the overall trend. But regardless, you can pick the dates. And I'm just going to go back to 2023. I probably did this the wrong way. There's probably an easier way to do it, but we're going to start first day of 2023, and we're going to go to the last day of 2023 and optimize on that date range. Just hit run. And I might see something similar, or if it's a different kind of trend, it might be something vastly different. But I'm optimizing on the same factor. I'm using the same range, and now I have slightly different parameters, 8 and 18, but it's close to 5 and 15. And so what I can do is I can rename this one and call it ES 2023 OPT. And this is where the work might comes in with optimization. It's not always about optimizing the settings, but it's really, I think, about optimizing over different date ranges, because you want to make sure it's robust. You want to make sure that these settings that you picked in one time period are actually pretty consistent over different time periods.
And that makes perfect sense, right? Because the market is not going to behave exactly like it did in the backtest moving forward. So
Right.
you need multiple timeframes historically to be robust, to be profitable, so that you have the best chance that that strategy with those inputs that you pick have the best chance to work and be profitable moving forward.
So let's see.
Let's talk a little bit. How much time do we have here?
It's a great question. I'd
We
go
have
all
five,
day, Mike.
we
You
have
know
five
that.
minutes. So let's kind of just look through and talk through a little bit about some of the things that you can do on the in that right panel in the optimizations, just to kind of fill out the functionality here. If you go to that top backtesting type, there's some other optimization tools here, which are walk forward optimization. There's some other advanced optimizations there, but let's just talk a little bit about walk forward for a second. And walk forward is the ability to forward test your strategy just using historical data. So what it does is it takes a portion of the data that you're selecting in your date range. In this case, we're doing 1 year from January to December. And it takes, for example, the first 9 months of the year and it back tests on those. It picks the best parameters and then it uses those parameters on the out of sample next 3 months of data. It's kind of like forward testing it, but doing it within the back test. And it shows you whether or not those parameters hold up on a sample of that same historical data.
It's almost like seeing if those factors are consistent throughout the time period, right? Anytime you back test something or you look at a strategy and you say, "Wow, this is great," you run the risk of getting in a time and implementing it where you might have consecutive losers, right? And so doing the walk forward allows you to see, well, is it a consistent distribution of winners and losers, or is it front loaded because there was some event or some sort of regime going on, and maybe there was a change in direction? But that's what walking forward allows you to do, to see how consistent is this with providing the results you're looking for.
In this case, the strategy that the best result here made $46,000 in 2023, but during that time there was a $12,000 drawdown. Now, that number is important for two reasons. One is it gives you the correct expectation that there is risk associated with this strategy. So that if you start trading this live with real dollars and you have a drawdown, you know that there is a risk of at least a $12,000 drawdown before the market, finally plays itself out. Can you look at real quick, Tom, the analysis again? Let's look at that $12,000 drawdown in the drop down there to show the equity curve.
Let me run that again. And then we'll go over here to the analysis.
So
This is the 3 and the 10. Now, I didn't change it. We can run 5 and 15. Let me just make sure we have the right parameters. That actually gave us a nice equity curve. There we go.
So there you can see that drawdown, right? From that $14,000 peak in September all the way down almost to zero. In fact, it actually lost money. So there was a big losing trade there that drew this market down. And this goes back to what Tom and I were talking about before, is that this is just a crossing strategy. It does not have any mitigation for those kinds of large losses, which you can build into the strategy with just some risk management techniques.
Right. And drawdown is the measure of from peak to trough. What is the biggest move? Right. So this is a really good example where you were profitable almost the entire time you're in the strategy, but no one, I think, who's really paying attention would allow a trade to last this long to lose all your profitability. Your risk management would have taken you out of there. And again, the strategy we're looking at is just for the signals. You could build a strategy that builds in the risk management, and this equity curve would look much more improved, hopefully.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.